There are a lot of ways where your great gross profit margin can be stripped. One of these is high research costs, another is high selling and administrative costs, and a third is interest costs on debt. All of these are called operating expenses and they're the thorn in the side of every business. We can also add depreciation and amortization, impairment charges, and the catch-all other that includes all non-operating, non-recurring expenses. When all of these that we have mentioned are subtracted from the gross profit, we have the firm's operating profit or loss. If you find my content valuable, please subscribe. It helps me keep creating more of what you love. Firstly, I would like to deep dive into selling, general and administrative costs, which we are gonna call SGA in future. To give you an example, these include salaries, advertising, travel costs, legal fees, commissions, all payroll costs, and many more. As a percentage of gross profit, they vary greatly from business to business. Companies that don't have durable competitive advantage suffer from intense competition and show wild variation in SGA costs. For example, Ford over the last 5 years has spending between 89% to 780 of its total gross profit, which means that they are losing money like crazy. What happens is that sales start to fall, which means revenues fall but SGA costs remain. If the company can't cut SGA costs fast enough, they start eating into more and more of company's gross profits. What we can conclude here is that the lower the company's SGA expenses, the better. In the world of business, anything under 30% is considered fantastic. There are also many firms with low to medium SGA expenses that destroy great long-term business economics with high research and development costs, capital expenditure, or interest expense on their debt loan. Here, Intel is a perfect example that has a low SGA ratio to gross profit. But because of high research and development costs, the firm has seen its long-term economics reduced to just average. Yet, if Intel stopped doing research, its current batch of products would be obsolete within 10 years and they would have to go out of business. Firms that have to spend heavily on research and development have an inherent flaw of their competitive advantage that will always put their long-term economics at risk, which means that the business is not a sure thing. Good example for high interest expenses is Goodyear Tire with 72% SGA expense to gross profit. But its high capital expenditures and interest expense from the debt used to finance its capital expenditures are dragging the tire maker into red every time there is a recession. But if they didn't add the debt to make all of those capital expenditures or improvements, they wouldn't stay competitive for too long. Lastly, I would like to take a deeper look at depreciation. Quickly, to define that, it is the amount by which the asset depreciated, and this asset has been used in the company's business activity of the year that generated the income. Quick example, imagine a $1 million printing press is bought by a firm. This printing press has a lifespan of 10 years. Because it has a lifespan of 10 years, the Internal Revenue Service will not let the company expense the entire $1 million cost in a year that it was purchased. Instead, the press must be expensed over the 10 years that it is in service. Depreciation could be a real cost as well, because if you think about that, at some point in the future the printing press would have to be replaced. I would like to emphasize that the $1 million expense for the printing press is not taken in the year that it is bought, rather it is allocated as a depreciation expense to the income statement in 100,000 increments over a 10-year period. A neat trick that some people use is that once the printing press is bought and paid for, the 100,000 yearly depreciation expense doesn't take any more additional cash outlays, but it does decrease earnings that are reported every year for the next 10 years. This means that, from a short-term perspective, the firm has a yearly cost that in reality isn't costing it any additional outlays of cash. Some can add that 100,000 cost back into earnings, which means the cash flow of the business can now support more debt for such money-making ventures as leveraged buyouts. There is an acronym for this earnings recalculation. It is called EBITDA, which stands for earnings before income tax, depreciation, and amortization. But if you ignore that expense in your calculations, eventually the printing press will wear out and the company will have to come up with another 1 million to buy a new one. But now the company added a ton of debt left over from the leveraged buyout and might not have the ability to finance the 1 million purchase. As with any expense that eats into a company's gross profits, less always means more when it comes to increase the bottom line. Next time we're gonna talk about the net profit and how it affects your business. Take care and see you then.